So now that we went through a brief overview of bonds and a lot of the vocab associated with them, we're now going to talk about the various calculations and journal entries that we need to do in order to record bonds. Before we get into all the details, I think it would be useful for you to create a bond study guide with me, which will cover all of the various journal entries and important terminology that you need to know when it comes to bonds. When we have bonds, there's three things we do with bonds. We issue the bond, which is when we borrow the money. We pay interest. And then we pay back the bond. And then as we learned, there's three types of bonds. There's bonds issued at par, a bond issued at a discount, and a bond issued at a premium. A bond is issued at par when the stated rate equals the market rate. A bond is issued at a discount when the stated rate is less than the market rate, and a bond is issued at a premium when the stated rate is greater than the market rate. When we issue the bond, we always debit cash, because we're getting money, for the issue price. And then we're going to credit the bond payable account, always for the face value of the bond. So I'm going to just rewrite that 3 times because that part won't change. So whenever we issue bonds, cash goes up because remember, we're the borrower in this. We're issuing a piece of paper and we're getting money in return. So our cash goes up and our liability goes up. If we're issuing the bond at par, there's no discount or premium, so the amount of cash we get and the bond payable amount is the same. So I'm just going to use 1,000 as an example. When we issue a bond at a discount, the bond payable is still going to be 1,000, but we have to sell it for less than the 1,000 because it's a discount. So let's say we sell it for 900. Well, hopefully you know debits have to equal credits, so we have a problem. Debits don't equal credits. So to make it balance, we're going to end up needing a debit to an account, and we're going to call it the bond discount account. And that's going to be just the diff, which is difference, to make debits equal credits. And in this case, that would be $100. When we have a bond issued at a premium, that means we sold it for more than the 1,000. So the face value is 1,000. We sold it for 1,100, let's say. So now in order to make it balance, we're going to need a credit to make it balance. And that credit is going to be to a bond premium account for the difference. And I'm sorry I'm squeezing that in. I'm also sorry that it creates random lines. All right, so we credit bond premium for the difference, and again, that would be 100. So you don't even have to memorize that we debit discounts and credit premiums, because automatically, if you know debits have to equal credits, if you debit cash for the issue price and credit bond payable for the face value, you're going to know what to do with the discount or premium account because debits have to equal credits. A bond discount is a contra liability, meaning it's a negative liability. It decreases the liabilities. A bond premium is just a liability. So what's happening? Assets are going up. Liabilities are going up. And I'm going to change my colors so it doesn't all blend in together. With the bond discounts, assets go up. The bond discount makes liabilities go down, and the bond payable makes liabilities go up. With the bond at a premium, the cash makes assets go up. The bond premium makes my liabilities go up, and the bond payable makes my liabilities go up. When we pay interest, we're going to debit interest expense by the carrying value of the bond. which we'll talk about what that is in a little while, times the market rate. And we're going to credit cash for the face value of the bond times the stated rate. So I'm going to do that 3 times. We're going to debit interest expense, carrying value times market rate. We're going to credit cash for the face value times the stated rate. We're going to debit interest expense for the carrying value times the market rate. We're going to credit cash for the face value times the stated rate. Put in my little X's to correspond with numbers. And I just hit some buttons, so that's fun. All right. So how am I going to remember this? Well, I've got a stupid way for you to remember it. Interest expense is always carrying value times market rate, and cash is always face value times stated rate. So I remember it by thinking cats meow, meow. That's right, I just meowed. Cats meow, meow. And fun stuff. CM, carrying value goes with market rate, and FS, fun stuff, face value goes with stated rate. So that's a dumb way that I remember it, but I never forget it. I'm doing bond problems, I'm thinking meow and fun stuff, and I don't make a mistake. Now, when we do our calculation, the carrying value times the market rate is going to be our interest expense, and the face value times the stated rate is going to be our interest paid. When a bond is issued at par, these numbers are going to end up being the same. When a bond is issued at a discount, because the stated rate is less than the market rate, the interest expense number ends up being bigger than the cash number. I'm making up these numbers. I just know because the stated rate is bigger than the market rate that I totally said that backwards. The stated rate is less than the market rate. That means that the interest expense is going to be greater than the interest paid. And then likewise, when we're issuing at a premium, the stated rate's greater than the market rate, which means the interest paid is going to be bigger. So 110 and 100 for the expense. Again, I'm just making up these numbers. When we do this now, we know that the entry for the bond issued at par is balanced, so life is good, but for our discount, we don't balance. We're going to need a credit to make it balance, so we're going to end up crediting our bond discount to make it balance by the difference, which in this case would be $10. And then we're going to end up debiting our premium on bond payable, or our bond premium, same thing, but I'll change it to be consistent, or I'll try to, bond premium for the difference, which is 10. So you can see that originally the bond discount gets debited, but once we do our calculation with cats, meow, and fun stuff, we're going to end up having to credit that bond discount in our journal entry for interest. Likewise with the premium starts with a credit, and then when we do our interest, cats, meow, fun stuff, we're going to end up needing a debit to the premium to make it balance. What's the accounting equation effect on all of this? Well, our expenses are going up and our assets are going down. For the interest expense and cash part. When we debit a bond or discount, we decrease the liability. So when we credit it, we're increasing our liability. When we credit the bond premium, we're increasing our liability. So when we debit it, we're decreasing our liability. At this point, I know this is overwhelming, But remember, this is the one-stop shop for everything I'm going to teach you for the remainder of the chapter. So you're just going to refer to this throughout the rest of the lecture, and then you're going to be able to see how it all pans out. So you're going to be able to see as we go through an example of par that all the entries I've laid out on this slide work. Same with discounts and same with premium. And then when we pay it back, I've got some great news for you. We always pay back the face value of the bond. So we debit bond payable for the face value and credit cash for the face value of the bond. And I can just draw a line across because those entries are going to be exactly the same for all three scenarios. And our number is going to be the face value, which is 1,000 in our example that I made up. So no matter what, when all is said and done, we always pay back the face value of the bond. Whether it's a bond issued at a discount, a premium, or par, we always end up paying back the same amount. So again, this is the one-stop shop for all of our bond stuff. In the next segment, we're going to go through and apply these concepts to each of the different types of bonds. And we'll start with a bond issued at par. So when a bond is issued at par, that happens when the bond contract rate, which is the stated rate, equals the market rate. And then if that happens, it's the easiest scenario because there is no discount or premium that we need to account for. So on January 1, Amazon issues a bond with a coupon rate of 10%. The face value is $100,000. The bonds start accruing interest on January 1 and pay interest June and December, so that's semi-annual. The bonds mature in 2 years. Investors are willing to pay $100,000 cash for these bonds, meaning the bond is sold at par. So this is what the bond timeline is going to look like. We have a 2-year bond, and it's semi-annual, so there's 4 periods. So N equals 4 because it's 2 years times 2 semi-annual periods in a year. So that's where we get 1, 2, 3, 4. And then each period we're going to pay interest based on fun stuff, face value times stated rate, which is the 100,000 times 5%. You might say, where did I get the 5%? Well, remember, the interest rate has to be cut in half when it's semi-annual. So we pay that 5,000 each and every period for interest, and then we're going to pay back the face value at the very end. The bond's issue price is what it's worth today, so that's the present value. Whenever the stated rate equals the market rate, the present value will always equal the face value of the bond, but you can actually use time value of money to calculate it. Here it's showing you how to use the charts. We're going to use our HP10B. So N for this bond would be 2 years times 2 semi-annual periods, or 4. I, in our calculator, you have to remember to use the market rate. Now, in this case, it doesn't matter because the market rate and stated rate are the same, so it's 10 divided by 2, or 5. PV is what we're looking for. That's going to be our issue price. And then our PMT is our fun stuff. That's the interest paid, face value times stated rate, which is the 100,000 times 0.05, which is 5,000. And then our face value is also our future value, so that's the 100,000. And if you pop all that into your calculator, you're going to find that the present value is indeed the face value of 100. Let's get the HP10B out, clear it out, move it over here so we can see my variables. 4 is my N, 5 is my I, 5,000 is my PMT, which technically I should make negative because if I'm doing this from the business's perspective, they're paying out that interest. And then the 100,000 face value they pay back at the end is also negative because, again, it's a cash outflow. Then what I do is I hit the PV button and look, it's a positive 100,000. It's positive because that's the money I get in when I sell the bonds, and it's the same as the face value because that will always be the case when the market rate and the stated rate are the same. So how do we do our journal entries? Well, when we issue the bond, if you follow along on that comprehensive guide I provided, you'll see we debit cash and we credit bond payable for the face value. The issue price and the face value are the same whenever a bond is issued at par. To determine the amount of interest, we're going to debit interest expense for cat's meow, carrying value times stated rate, and we're going to credit cash for fun stuff, face value times stated rate. The carrying value of the bond is the face value plus a premium or minus a discount. Because we don't have a premium or discount, the carrying value effectively is the face value. And then the stated rate is half of the 10% or 5%. Likewise, the face value is $100,000 and the stated rate is 10%, just like the market rate. We cut it in half and it's 5%. So that's going to get us our journal entries. So whenever we have a bond issued at par, it's the easiest situation because the market rate and stated rate are the same. And I noticed the typo there. That should be market rate. They're the same, so it didn't matter, but I want you to get the right notes down, so sorry about that. It's cat's meow, meow, carrying value times market rate, and fun stuff, face value times stated rate. They're always going to be the same when the bond is issued at par. So interest expense is going to be reported on the income statement, and because interest is related to financing rather than operating activities, it's normally included in the non-operating section or the peripheral activity section. Interest expense, therefore, is usually shown below the operating income. That's a review from past information that we covered. Though it's not shown on the slide, if we were going to pay off the bond, we would debit bond payable for the $100,000, which is the face value of the bond, and we would credit cash for the $100,000. So it's not shown in the PowerPoint, but you may want to make note of it. Our liability and our cash goes away at the bond's maturity.